Every bull market brings new opportunities and new traps. Launchpads, presales, IDOs, and token fairs all promise early access to the next big thing. Get in before it launches, they say. And sometimes it works. Early investors catch huge returns. But most of the time, the opposite happens. The project disappears, the team vanishes, and the money's gone. That's the classic rug pull. So, how do you tell the difference between a real launch and a ticking time bomb? Let's start with the basics. A Launchpad is a platform that helps new crypto projects raise funds and distribute tokens. In theory, it's like a decentralized Kickstarter. Investors contribute before launch, and in return, they get early tokens. Pre-sales happen even earlier, usually before public listing, offering cheaper prices for early believers. Sounds fair, right? Except, in practice, it's where most scams hide. The problem isn't the idea, it's the execution. In a space with no centralized oversight, anyone can create a token, write a website, and claim to have a revolutionary project. Add a few AI-generated team photos, a roadmap full of buzzwords, and a countdown timer. And suddenly, it looks legitimate. People FOMO in, liquidity pools open, the token pumps. Then the developers pull the liquidity or dump their allocation, and everything collapses overnight. That's the anatomy of a rug pull. To protect yourself, you have to stop judging projects by hype and start judging them by structure. Here's how. Step 1. Check the tokenomics. Real projects design their token supply with long-term sustainability. Scams design it for extraction. Ask these questions. Who holds the majority of tokens? Are team and investor tokens locked? What's the vesting schedule? If 30–50% of supply is unlocked at launch, that's a red flag. If the team can sell immediately, they will. Step 2. Verify liquidity. Every new token needs liquidity to trade. If the project's liquidity pool is on-chain, check if it's locked or unlocked. Platforms like Unicrypt or Team Finance allow teams to lock liquidity for a set period, 6 months, 1 year, or more. If liquidity isn't locked, it can be pulled instantly. No lock, no trust. It's that simple. Step 3. Analyze the Launchpad itself. Not all Launchpads are equal. Some, like DAO Maker, Binance Launchpad, or CoinList, perform heavy due diligence. Others are open to anyone willing to pay listing fees. Look at their past launches. If most of them collapsed or never reached exchanges, the platform doesn't vet properly. A good Launchpad protects its reputation because its brand is its business. Step 4. Check the audit. Security audits are no guarantee, but they're a minimum requirement. Look for audits by reputable firms like CertiK, Halburn, or Trail of Bits. Fake projects often display logos of auditors they never worked with. You can verify this by checking the auditor's official site. Legitimate audits are public and time-stamped. Step 5. Follow the money. Smart money leaves footprints. Before joining a presale, check whether known wallets, VCs, or Launchpad partners are involved. If the only partners are random Twitter accounts, walk away. Also, trace the presale wallet address on-chain. If funds are moving to exchanges or mixers before launch, that's a massive red flag. Now let's go deeper, because not all rug pulls are outright scams. Some are slow rugs. The project launches, developers keep updating, but token emissions outpace demand. Early investors dump, price bleeds for months, and the community fades. No fraud, just poor design. That's why tokenomics and utility matter more than marketing. So how do you separate noise from signal? Look at what the project is actually building. If it's a real protocol, it should have a product, even in early form, a testnet, a demo, an open source repo, or an MVP. If months go by with only marketing updates, you're not funding builders, you're funding storytellers. The next filter is community quality. Don't just count followers, measure engagement. Do people ask real questions or just spam emojis? Are developers active in Discord or Telegram? Healthy communities discuss features, bugs, and improvements, not just when listing or price predictions. If all the excitement is about token price before product delivery, you're probably too early or already too late. Let's talk psychology. Scams thrive on urgency and exclusivity. Limited time offers, private allocations, guaranteed returns. Those phrases are designed to shut down critical thinking. The moment you feel FOMO, stop. Real projects don't need to pressure you. They build confidence through transparency, not deadlines. Now there's another layer: KYC and regulation. Some launchpads require team verification through third-party KYC providers. It's not perfect, but it raises the bar. If the team refuses any identity verification, that's fine for open-source DeFi, but not for retail-oriented fundraising. If you're putting real money into a team-based project, you deserve to know who's behind it. Here's a quick 5-step survival checklist before joining any presale or launchpad. 1. Verify the contract and audit. Never invest in unaudited contracts. 2. Check token distribution and locks. No vesting equals instant dump. 3. Track liquidity locks. Unlocked liquidity equals potential rug. 4. Research the team and partners. Fake LinkedIn profiles are common. Reverse image search them. 5. Read the fine print. If there's no clear refund policy, no launch timeline, and no product progress, you're gambling, not investing. Let's connect this to the macro side. As regulation tightens, legit launchpads are evolving. We're seeing hybrid models, where tokens are issued under compliance frameworks, using identity layers and escrow contracts. That's the future of on-chain fundraising: transparent, verifiable, and legally sound. But until that becomes standard, skepticism is your best defense. In crypto, the same rule applies as in life. If something sounds too good to be true, it probably is. Launchpads aren't inherently bad. They democratize early access. But decentralization without diligence is just chaos, and chaos rewards the reckless, not the prepared. So the next time you see a flashy presale countdown with 100 times potential, take a breath. Ask the hard questions, follow the contracts, and remember, you don't need to catch every launch. You only need to survive the bad ones to be here when the real ones appear. This is not financial advice. It's a framework to help you stay safe in the early stage market, where opportunity and risk always arrive in the same package.